OG John AG here. If you hold silver, if you're thinking about buying silver, or if you're tired of watching red and green candles without understanding the bigger game, you need to lock in on this update. I want you to imagine something simple. You walk into a store in New York and buy a brand new phone for $70. You cross the street, walk into another shop, and instantly sell that same phone for $120. You do this 10 times a day. Is that genius business, or a sign that the system is broken? February 2026, we're living through exactly that kind of glitch in the silver market. In Shanghai, silver has traded up toward $120 an ounce. In the West, the spot quote is still chilling around $70, $80. That's not a small gap. That's not just volatility. That is a massive wealth transfer between East and West happening in real time. Pull your chair closer. You didn't click this video by accident. You clicked because you feel that something is off. When silver is supposedly plentiful on a screen but impossible to get in size in the real world, your gut is right. Give me your full attention. This is not for tourists. Segment 1, the $100 bill for $41. What the market is ignoring. Let's start with third grade math, not Wall Street math. Imagine I put a real $100 bill on the table in front of you. You can see it, smell the fresh ink, feel the paper. And I say, I'll sell this $100 bill to you for $41. What do? Call the police because I'm crazy, or empty your wallet and buy every single bill I have? The answer is obvious. But here's the glitch. The financial market, full of PhDs, algorithms, and smart money, is looking at that same $100 bill and saying, no thanks, I'd rather buy some digital nonsense for $1 million. Now translate that to silver. There's a real company, a real asset, sitting on 247 million ounces of silver equivalent in the ground. That number is not small. Visualize it. 247 million 1-ounce coins stacked up would tower higher than any building on Earth thousands of times over. Now look at how the market values it. On average, for similar peers, the market pays about $3 per ounce in the ground. This situation, it's being valued at about 0.41 per ounce, 41 cents. That's a gap of more than 700%. You are literally being offered a sports car for the price of a beat-up bicycle just because the dealer forgot to update the tag. This is not just cheap. This is mispriced reality. In finance, mispricing is pain for the ignorant, opportunity for the prepared. Segment 2, the cash fortress. Why this isn't cheap garbage. Now, something can be cheap because it's garbage, or it can be cheap because the market is asleep. The story here doesn't stop with ounces in the ground. This company, the example we're using as a lens today, is sitting on roughly $55 million in cash. In the brutal junior mining world, 90% of companies are begging for money just to keep the lights on. They issue endless new shares, dilute shareholders, and still end up on life support. But a company sitting on tens of millions in cash in this market is like driving an armored tank through a shanty town. They don't need to print more shares just to survive, don't need to crawl to banks for mercy. Have the power to wait, to acquire, to advance projects while others are dying. In a liquidity crisis, cash is oxygen, and this tank is fully loaded. So we're not talking about some cheap junk stock. We're talking about big silver ounces in the ground, plus a big cash cushion, plus a valuation that prices those ounces at cents on the dollar. This is why we need to zoom in. Segment 3, the free lunch, tailings and money on the surface. Now let's talk about the concept I love, money on the ground. In Nevada at the Hughes Project, there's something called tailings. It sounds like waste. Most people hear that word and think garbage pile. But here's the trick. In the early 1900s, mining technology was primitive. Miners took only the obvious big chunks and threw away the rest. They piled that waste rock beside the mills, creating artificial hills. Those hills? They're not just dirt. They contain silver, already mined, already crushed, sitting at surface. The tailings at Hughes contain about 2.74 million ounces of silver. And here's the magic. You don't have to drill thousands of meters down. You don't need explosive charges. You don't build elaborate underground tunnels. You literally drive up with a loader, scoop the material, feed it into a modern processing circuit. Mining cost? Almost zero compared to a conventional underground mine. When silver trades at 100 plus, like we're already seeing in Shanghai, that waste pile becomes a near pure profit machine. This is low-hanging fruit. This is money on the sidewalk in mining form. So we have a giant resource base, a cash fortress, and near-surface silver that can be monetized quickly when prices rip. Yet the market still says 41 cents per ounce is fine. That's not fine. That's a coiled spring. Segment 4. Silver is not coming back once it's used. Now, forget the company for a second. Let's talk about silver itself. If you think silver is just coins, jewelry, shiny stuff for collectors, you're living in the past. Silver is now the blood of modern industry. Everywhere you look, it's disappearing into devices, solar panels, electric vehicles, high-end electronics, AI server farms. Take solar as a simple example. Every solar panel uses a little bit of silver paste in its circuitry. When the panel is manufactured, that silver is burned in, it gets locked into the panel. The panel sits on a roof for 20, 30 years. Does that silver come back to market next year? No. It's gone from available stockpiles for decades. Same story with EVs and electronics. Silver is the best electrical conductor we know. You can't fully replace it with copper or aluminum without making devices much bigger, slower, less efficient. So we have one-way demand, silver going into products and not coming back quickly, limited supply growth, no wave of new mines arriving before 2030, according to mining executives and sector research. Simple math, 2026. Now zero meaningful new silver mines expected before 2030. That's at least 4 more years of a structural supply hole. Demand is going vertical, supply is flatlining. In economics, when vertical demand hits a brick wall of supply, prices don't adjust slowly. They spike. Segment 5, East versus West. 2 silver realities. Now, why do we see silver at $70, $80 in New York while it trades near $120 in Shanghai? Because we don't have one silver market anymore. We have 2 realities: the Western paper market, futures, ETFs, promises, contracts, the Eastern physical market, actual bars, actual coins, actual deliveries. In the East, countries like China and India are not buying silver for a quick trade. They are strategically hoarding, building stockpiles as a hedge against energy shocks, tech supply chain, risk currency instability. That's why silver on the Shanghai exchange can command a $40, $50 premium over Western prices. The East is essentially saying, if you want real silver, pay real money. If you want cheap paper promises, stay in New York. At the same time, silver bars in London and New York vaults are steadily draining. They're being packaged, loaded on ships, and sent east. Western exchanges are slowly turning into empty showrooms, lots of contracts, fewer deliverable bars, more cash settlements. When someone actually dares to ask for physical try, ordering 1,000 ounces of physical silver from a bullion dealer today, often you'll hear, "We have to order, come back in 2 or 3 weeks." Why? Because the metal is not sitting around in big surplus anymore. The supply chain is stretched tight. Segment 6, the 4 filters to find a real silver warhorse. Now let's get practical. We've talked about mispricing cash fortresses, tailings structural deficits. How do you actually use this as an investor? You need a filter. The original video laid it out as 4 key criteria, and I fully agree with this framework. Write these down. Stick them near your screen. Criterion 1, cash fortress. In mining, cash is oxygen. Look for companies that can survive 3 years with no help. Enough cash to keep drilling, enough cash to keep staff paid, enough cash to avoid dilution every 3 months. These are the companies that can gobble up assets when everyone else is on their knees. Criterion 2, safe jurisdiction. Never place your future in a place where governments can wake up and decide to nationalize, or where bullets are more common than birdsong. Look for Nevada, Alaska, Canada, stable parts of the US and Mexico, other rule of law regions. If you can't sleep at night because of political risk, it's not worth it. Criterion 3, low cost or free lunch ounces. Prioritize tailings, shallow open pits, projects with existing infrastructure. Why? When silver spikes, low-cost ounces turn into instant cash flow. They are the first to benefit and the last to die in a downturn. Nerd term, ultra-low operating cost, high leverage to price. Criterion 4, valuation arbitrage. Compare company's market cap to its ounces in the ground. If the sector pays $3 per ounce and you find a similar company priced at $0.30, $0.40 per ounce, you've just found a pricing glitch. That gap is your margin of safety on the downside and your multiplier on the upside. This is how you stop chasing names that already ran 10x and start hunting the ones that are mispriced before the crowd arrives. Segment 7, mindset, patience, capital, and sanity. Now, none of this matters if your mindset is broken. If you think, I'm going to get rich by next Thursday, silver will punish you. 3 mindset rules. 1, use only idle money. Never use rent money, grocery money, emergency savings. Only deploy money that you can forget about for 3 years and still live your life normally. If silver drops 10%, you sleep fine. If silver goes sideways for 6 to 12 months, you don't panic. 2, be a farmer, not a gambler. You're planting seeds, real assets, in real projects. On real land, you let time and structural trends do their job. Farmers don't dig up the seeds every day to see if they've sprouted. They understand seasons. 3, filter the noise. Headlines will say, silver is dead. Crypto is the new gold. AI will solve everything. Ignore the hype, both bullish and bearish. Look at solar panels on roofs, EVs on highways, physical shortages at bullion shops, draining vault inventories. That's reality. Tickers and headlines are just noise. Segment 8, what you should actually do next. I'm not here to hand you a ticker symbol and say, buy this now. That's not how real wealth is built. What I want you to do is take the 4 filters: cash, jurisdiction, low cost, valuation gap. Apply them to any silver miner you own. Any new play you are considering, ask, does this company have enough cash? Is it in a safe place? Does it have low cost leverage to price? Is the valuation a $1 for near 40 situation or a $1 for 150 situation? If you feel overwhelmed, start with the example we walked through. High ounces in the ground, big cash position, tailings and low cost ounces, selling at 0.41 per ounce versus $3 peer average. Use it as a benchmark, not as a blind recommendation. Read their financials, check the team, look at the projects on a map, trust your own due diligence, not just mine. Segment 9, call to action. For your viewers, you're watching John AG. Here, and I'm OG John AG. If this special silver update helped you see why Shanghai at $120 versus New York at $70, $80 is a signal, not just a chart quirk. Why one company can sit on 247 million ounces plus $55 million in cash and still be valued like trash. Why tailings, deficits, and east-west flows matter more than intraday candles. Then, hit subscribe right now so you don't miss the next deep dive. Smash like so YouTube knows you want serious silver content, not fluff. Drop a comment with focus if you're going to start using the 4 filter method. And tell me which of the 4 matters most to you. Cash jurisdiction, low cost ounces valuation gap. We're going to keep tracking the premium gap between East and West, the drain in London and New York vaults, the projects that look like $1 bills selling for 0.40, and the timeline for new mine supply actually hitting the market. You're early just by understanding the problem.